Hello, everybody, and welcome to the Cyclical Investors Club YouTube channel. My name is Corey Kramer. Today, we are going to be analyzing Hologic Inc., ticker HOLX. This one came in by request down in the comments of one of my other videos. If you have a request you'd like me to take a look at, just put it down in the comments. I'll put the ticker up on the chalkboard behind me, and once I do that, I'll let you know that it's up there in the comments. I do it a couple times a week. I run through and add all the tickers to the list. Some of these I post on YouTube. The rest I post on the free tier over on Patreon. So make sure to check those links out down in the description. I also have weekly picks over on Patreon for $25 a month. Those have been going really well since I started it last October. So check that out as well. As always, this is not individual investing advice, just how I analyze stocks. Hologic was a request, as I said. So let's take a look. This one's pretty interesting. Sometimes I get a little more excited when there's more to talk about sometimes. I think these guys are in the S&P 500, if I recall correctly. Let's look and see what the AI description of what they do is. Okay, structured around four major segments: molecular diagnostic tests for detecting infectious diseases, including HPV, chlamydia, HIV, and hepatitis, COVID-19. Number two, breast and skeletal health. So mammogram systems, screenings, bone density, it looks like, for osteoporosis, and then surgical. They have minimally invasive surgical products used for gynecological procedures. So kind of a women's health focus, it sounds like. I've actually, with a lot of diagnostics and things like that. So I've owned this stock before and done well with it, and I've written about it, but I don't think I've ever made a video on it before. So I want to go back, since I do have a little bit of a history, and take a look at that over on Seeking Alpha. So I bought this in the Cyclical Investors Club over on Seeking Alpha in 2020. In March 2020, and it took me a few weeks because I bought 30 stocks in March of 2020 during that crash, and 20 of those were in the S&P 500. So I wrote articles about those 20 over the next like 2 months or so. So you can see this first one came out on May 8th, 2020, and it was kind of a neutral article, but I went through all 20 of those and explained my process of why I bought them. The interesting thing about a lot of the stocks I was able to buy in March 2020 is that they didn't have a lot of times they were bigger mid caps, okay, or smaller large caps that didn't have a lot of like public name recognition. So they didn't have a lot of like, they weren't Starbucks or something like that, McDonald's. What I want to look at here is the dividend, which doesn't exist. Okay, good. I wasn't sure if they had a small dividend or they didn't have any at all. So one of the patterns that I noticed after I had bought all these stocks in March is a lot of them didn't pay dividends, or they were quite small dividend yields. They weren't well-known brands. And really, if you needed to have a system of monitoring stocks where you were looking at numbers and not name recognition, or dividends were really had grown really popular during the 10 years leading up to the COVID crash. And so I was just looking at the numbers. Honestly, when I bought this, I didn't really know what they did because I was buying stocks so fast. I was looking at the numbers and assuming history would kind of work itself out over time, and I bought stocks fast. So I was able to buy this one near the bottom of the March 2020 crash. And the reason it got low really was because of investors. It wasn't the type of stock like investors knew enough about to come in and like, it wasn't on people's buy list like during a crash, during a sell-off, like some stocks were. And like I said, you really needed to have some quantitative basis of looking at the numbers and understanding what was happening. So I wrote this article, and then it was only on August 18th, I probably sold it a couple days before I wrote this article, where I sold the stock for valuation purposes at the time. So if we go back and look, and the reason I kind of go through this is I know that, a lot of people don't use the same sort of valuation methods that I do, although the one for this is pretty straightforward. And so if I have evidence that, what I'm doing can work, or can work well, then I like to kind of show it, because these are public articles at the time. They might be behind a paywall now, but you can see that I wrote the sell article and I had sold it really like 6 months later, and the stock had made 122% profit compared to the S&P 500's 41%. So I tripled the return of the S&P 500. The valuation got expensive really fast using the same metrics that I was using basically to buy it when it was cheap. And, I took profits, and I track it still, but it hasn't really looked too interesting since then. So let's go look and see what happened. So I bought down pretty much at the bottom, if I remember correctly. And that was in August, mid-August, I'd sold by here for sure. So yeah, so that I got a little bit more profit than that, but that's about what I did. Now, a person could have potentially tried to get a peak price, which is not usually what I'm trying to do with a type of earnings stock, earnings-based analysis. It's just valuation-based. Now, I didn't know at the time that these earnings... Now, remember, I'm using still backward earnings at this point when I sold. I didn't know they were going to spike up to this kind of unbelievable level due to COVID, right? I didn't try to predict that or anything. I'm still looking back at the historical longer-term trends. So perhaps there's another person out there who managed to totally get this peak correct, slightly higher than when I sold. But I'm going to say for the most part, there probably aren't any other investors that weren't in the Cyclical Investors Club that have made as much money off of this stock over the past decade. Certainly not buy and hold investors haven't done that, as I was able to do in this short amount of time period. And then I get my money back and I can go invest it in other things. Now, it doesn't mean every single stock works this way. If it's a small growth company, then I might hold it through kind of a high valuation. That wasn't really the case. These guys had good growth, good business, but at the time it didn't look like it would justify a higher valuation than when I sold. So basically anybody who bought, I'm just going to do a buy and hold. I kind of picked a little bit so that's only a 61% gain. You kind of have to go back to more than a decade ago. Yeah. So you basically need to get back to before 2015, more than a decade, to get the same returns I got in 6 months. Okay. It doesn't always work out that way, but it's the difference between understanding your own strategy for that specific stock and sticking to it. I've had other ones, Align Technology, I think I made a video of, where I made similar returns. It went on to double again to a crazy, it followed more this earnings price spike that we saw here, and then came back down, and now it's cheaper than when I sold it, just like this one is. So several lessons here. One, if a certain, it's not just dividends. If any, there are all kinds of meme stocks and everything else, but when any specific strategy gets popular, and at the time, dividends were popular, brand names were popular stocks, that a lot of retirees, a lot of boomers who had money, who were going into retirement or in retirement, they really were attracted to those, and that's what they were mostly paying attention to. They missed this one because it doesn't pay a dividend. It's not on any dividend streak list. It's not a well-known brand name, so it slid under the radar, and that's how I was able to make the money that I was on it. Now, there can come a time when this was a basic earnings strategy. I probably used a recession strategy too, which I'll show you in a second. But now if everybody goes all like Peter Lynch and peg ratios and stuff, which is mainly what I'm using for a stock like this, if people want maybe just a steady earning business. So if you look at, which I see a lot of now, but it's usually with the brand names and dividend payers as well that people like. So this is a very steady earning business, right? Earnings growth was 20%, but even if we get past that little bump. We have 7.5%, we'll call it, percent earnings growth over this decade. That's solid. It goes up nearly every single year. If this was a stock that paid like a dividend, it would have traded much more than a 20 PE, I think. At least a 25 to upper 20s based on what I've seen with a lot of other stocks. So you kind of, there's no perfect strategy all the time because, well, valuation can work too. You can be like a value investor, like old school, like below book value, below peg of 1 or something like that. But the problem you can run into is you just don't get very many opportunities, right? So there can be different sets of problems, but there can be problems whenever any strategy becomes too popular. People eventually are willing to pay too much for it, or they snatch up the deals before you can get to them, right? So those are kind of some important lessons to keep in mind here before we get into my valuation. Now, what's going on with this spike is you saw all the diagnostics and stuff that they do. Well, we needed all those during COVID and we used them all. And so we had a boom and then we had a bust. And now we're, I think, in a more normal area, potentially. I mean, before COVID, we were earning $2.49 a share. Now they earned $4. So, you could kind of stretch out there. I didn't do the math on the growth, but if you just imagined this COVID area wasn't here, you can kind of draw a line up there. They're kind of in that range. Analysts are expecting 8 to 10% growth after this year. So, but these 2 years have only been 3% growth, and that's why the stock is trading as cheaply as it is. So it's pretty interesting here because there's a lot of other stocks that are more overvalued. And I think socially we've kind of gotten, there's going to be a bunch of people who, it's hard to say it out loud, but there's a bunch of people who really hate HPV, right? Like the vaccinations, hepatitis less so, but I've definitely seen pushback from giving pregnant mothers hepatitis shots before their babies are born because they're low risk, but doctors recommend them. And then, of course, we all know COVID, people are kind of against that. So I think certain groups of people, a lot of people in the U.S. So you can understand why there's some headwinds on a company that's doing the diagnostics and stuff for that. I think longer term, a lot of this stuff is going to work itself out because, sometimes people need to experience things firsthand before they believe them or take them seriously as they need to. And so, before COVID, all these things were kind of producing decent earnings growth. And now I think we're in kind of a little bit of a backlash from a social backlash sort of against some of this stuff. But the reason we have try to prevent this stuff and treat it and everything, and it could be good for them if more people get it, right? So I think eventually that will work itself out. Now, how many years that takes, hard to say. People can be kind of stubborn sometimes, it appears. But ultimately, when you get sick, right, then people don't usually totally resist the cure or having it diagnosed. So I think that's something that will work itself out. I don't know what level of earnings and earnings growth that'll be, but that's kind of my take on this decline here. Is this election time? Yeah, right. So we have election right there. And then now we're down, call it 30% since then, right? So it's definitely, related to some of this stuff. There could be funding things that go into that too. I haven't looked into that, but basically I think when it comes to some of this health stuff, once people get sick, then they'll change. Most of them will change their minds. So long term, that's kind of, I think it's going to be okay. I wouldn't avoid this stock necessarily if I could get it at the right price. So let's look a little bit at the valuation here. All right, so the basic valuation looks really good if you assume they can grow 9.8%. Even if I change this to 9, I think it's still good. Yeah. So a 9% growth rate. I want this. This is the 10-year earnings CAGR. So this is if you bought the business and the debt, which they have just a little bit of. How long would it, I mean, what kind of CAGR would you get from the earnings that you earn from the company and the earnings growth over time, over 10 years? This is actually 10 years. So if they can grow, if you buy it at today's price, they can grow earnings like 9%, then you can get about an 8% CAGR as a business owner, viewing it from that perspective. That's pretty good. That doesn't include any like price appreciation, right? So that's just the amount of earnings you could make, what you could make from the earnings as an owner. If you want to get a valuation, we can do that. Whoops, normal PE maybe. There we go. So you can also potentially get some mean reversion if the market starts treating this as it used to, and it trades at a 17 PE. Then over what, 2.5 years, you get a 55% return. That's usually pretty good, actually. I mean, there are some stocks I'm buying that are kind of in this situation. So that's a good return. Well, it'd be a 20% annual, very good return, but it'd probably slow down, after that, unless you kind of get a giant spike like I had back here. So there are returns that can come that way as well. I'm not assuming any of those with this 8%. Most stocks aren't anywhere close to this level of return. So it's valued pretty cheaply right now. I think the real question is going to be, what kind of earnings growth are we going to get after this year? If we get that 9%, it's good. If it's 3% like it's been, that's barely covering inflation. And so if that's the case, then the current valuation is justified. It's not like super cheap. Now for me, I still want, I'm looking at more of a recession buy price. So that'd be closer to $46. The normal buy price would be 58, which it's below right now. So the way I think about the recession buy price is I go back and look at what happened during the Great Recession. Get rid of this. And what I'm doing is I'm creating a PE based on the peak earnings, which would probably be $1.11. The low price, which looks like it'd be $9.42. I'm creating a PE out of that number. I didn't re-update this, so this is how, I don't remember if I used $1.11 or $1.17. Usually I go backwards in real time what the market was thinking. This gives me kind of the most pessimistic view for evaluation. And then what I do is I raise that PE 40% off the bottom. And that, because I'm not assuming things will get exactly as bad as they are here. What I want to do is avoid buying it, during, let's see how far the stock fell. Stock fell almost 75% during the Great Recession. Okay. But it did start at a higher valuation. If it started at like a 20-ish, like it is here, that decline would have been more like 55% for the stock price. Earnings didn't even decline for these guys during that time. They did kind of level off and go much slower than they had been. So I use that as a model. And when I do that, and I kind of, again, adjust that 40% off the bottom, that gives me this $46 buy price. This is adjusted for the little bit of debt that they have as well. So the stock needs to fall about 18% more before hitting that buy price. And, unless something like really horrible happens, you might, if a person was going to do more work on it, they might look at potential federal budget cuts to maybe some of the testing and stuff that they do. I don't know the mechanics of all that. So that might be one area to look at that could cause earnings growth to be slower. So I bet if I put 3% in here, or 4%, let's do 4%, that it'll probably be like 5.3. Oh, it's still pretty good. So the market really is discounting a lot. Yeah. The market's assuming like no growth for this stock right now. So maybe I'll even just put 0. Yeah, the market's assuming. So this is about where the S&P 500 is, about this 5.4% or so, 10-year CAGR. So they're assuming no growth for this business, pretty much at all. that's usually a good time, as long as the business is solid, where you can think about buying. So that's why this normal buy price looks good. Basically, what I'm waiting for is a margin of safety. And then also what that does is it gives you better returns. That's how you get 120% return in less than a year under the right conditions. It's by getting that margin of safety. Maybe earnings do have a couple rough years and you have to wait longer, right? So there's a lot of things that can go wrong, but we're definitely in an interesting area for this stock. So thanks for whoever asked about this one. It was an interesting one to look at. If you saw me using Fast Graphs here for this, I have a affiliate link down in the description for 25% off if you want to try Fast Graphs, and they have free trials over there. So, you can look at the COVID spike here just very clearly, pretty easily. And you can go back and do this basic valuation stuff pretty much all on Fast Graphs. So that's kind of nice. All right, everybody. Thanks for watching, and I'll see everybody later.